All right, so I'm sitting down with Mrs. Foreman, and we're going to talk about some inventory, different inventory concepts in accounting. This is for the Go Forward project in financial accounting. So the first question we'll be asking is, or first thing I'm going to ask is, let's start by talking about what your background with accounting is.
Sure. So I have a degree in accounting.
Mm-hmm.
I'm a CPA.
Yeah.
I'm a partner at PricewaterhouseCoopers and have been for 9 years, but I've been in accounting since I graduated from college. So I've been at PricewaterhouseCoopers for 19 years and been working for 26.
PricewaterhouseCoopers.
Yes.
Awesome. Okay. Moving right along to the next question. So in your opinion, why would it be important for companies to use methods for tracking their inventory levels?
So inventory is important because it helps you understand the profitability on what you sell.
Mm-hmm.
So inventory is effectively anything that you may sell, goods to somebody else. It's important that you track what's on hand so you know the money that you've brought in less the cost that you incurred to buy that,
yes,
and that you have the right revenue.
Right.
Or
Awesome.
right net income, I guess I should say.
Right. So next question is going to be to help me understand the relationship between a consignor and a consignee.
So the consignor typically owns the inventory, and the consignee does not.
Yeah.
So sometimes a consignor will send inventory to the consignee to sell.
Right. Awesome. Moving right along to question number 4 is, as it relates to businesses, what would you say inventory is?
So, sorry, I think I might have jumped the gun and answered this earlier, but
Yeah.
Inventory is
Yeah,
something that you sell in your business.
Yeah, totally. Yeah, the previous question kind of touched on that a little bit.
That's okay.
And so how would you define the expense recognition principle?
So effectively, expenses are supposed to be recognized in the period in which they're incurred,
Mm-hmm.
and that should match the revenue with which they're associated.
Right, yes. Awesome. So my 6th question is going to be, internal controls are important to any company. Why are physical counts of inventory necessary?
So physical.
And I know how I would answer this, but yeah, obviously
Okay.
I want to hear how
Okay.
you answer.
So physical accounts are necessary so that you know how much inventory you have on hand. There are companies that rely on internal controls, so they have systems that are very accurate in terms of knowing
Mm-hmm.
the inventory they have, the inventory that went out.
Right.
And sometimes internal controls can be relied upon to determine your inventory levels, but most companies do a physical at some point during the year to ensure that those controls are working.
Yeah, and I just like to think that it's like you want to match, like you need to make sure that the physical counts, the count that you have in your book matches like the real amount.
Exactly.
That's
Yep.
what I think. So our last question number 7 is going to be, companies use several methods to measure inventory. As you understand them, how would you describe the FIFO, or first in, first out method, the LIFO, last in, first out method, and the weighted average methods?
Maybe to describe these using an example, if you had 10
Mm-hmm.
items of inventory, using the FIFO method, it would be the first item that you bought
Mm-hmm.
that would be disposed of first. So it would be the earliest
Yep.
one acquired that you would dispose of when you had a sale. LIFO is the exact opposite. So LIFO would be that last item that you acquired, that 10th item would be the one that you dispose of first.
Right.
And weighted average is in the middle, so it would take the average cost of all that inventory, and that would be your cost of disposal.
Okay.
So a lot of people believe FIFO is the most accurate because it matches your most recent cost to your sale.
Yeah.
But the most complicated as well.
Right. Awesome. And so that's my last question for you. Thank you very much for doing
You're
this with
welcome.
me. It was it was awesome. Thank you very much.
Thanks, Matt.